The Indian stock market witnessed a volatile session on Monday, with the benchmark Nifty 50 index ending marginally higher at 14,634.15. The index formed a hammer pattern on the daily charts, which is a bullish reversal pattern that suggests a potential trend reversal. So, what should traders do on Tuesday? Here are some possible trading strategies based on the hammer pattern formation. Buy on dips. The hammer pattern suggests that the market may have found a bottom and could reverse its trend. Traders may consider buying on dips with a stop loss below the low of the hammer candle, which is at 14,535.50. If the market continues to move higher, traders can look for potential targets at 14,700 and 14,800 levels. Wait and watch. While the hammer pattern is a bullish reversal pattern, it's important to confirm the trend reversal before taking any positions. Traders may wait for the market to move above the high of the hammer candle, which is at 14,695.55, before considering long positions. Sell on rallies. While the hammer pattern suggests a potential trend reversal, it's important to note that the overall trend is still bearish. Traders may consider selling on rallies with a stop loss above the high of the hammer candle, which is at 14,695.55. If the market continues to move lower, potential targets could be at 14,500 and 14,400 levels. It's important to remember that trading involves risks, and any decision should be made after thorough analysis and risk management. Traders should also keep an eye on global cues and any major developments in the domestic economy and corporate earnings.